Hello, everybody, and thank you for joining us this month for a housing market update with the one and only David Arbit. My name is Ann Cadle. I am the marketing specialist here at MAR. And a few things before we get started. First of all, we'll hold all questions until the end, and David will answer as many as he can when we get there. But during the presentation, if you would like to ask a question, you can at any time, if you put it in the Q&A function along the bottom of your screen. Also, this presentation is being recorded and will be available on the website later today or tomorrow. And with that, I'll hand it over to David.
Thank you, Ann. And let me get going here. Welcome, everybody. Thank you for joining us. I'm going to get my screen share going here for us. You know, it's one thing to kind of talk about your charts and talk about the market, but you know, I believe in showing and not always just telling. So I like to show you guys some of my charts that are so familiar and so beloved, mostly by me, but maybe by a few of you as well. All right, so let's get going, guys. We've been doing these for some time. It sounds like you guys are getting some value out of them. I hope you are. And we've been tracking, you know, some of the same things as well as some different things. So today is going to be a little bit different. We're going to talk some affordability issues, and we're going to talk a little bit more about the economy than we have been. So a little bit of a change of pace, and I hope you guys get a kick out of it. All right, so as I usually do, I always promise you guys this will feel like drinking from a fire hose. As I also always tell you guys, you know, you can have the slides afterwards. So don't feel bad if some of this stuff is just going by a little fast, because you will have the content. So with that, I want to also mention kind of where to access some of the stuff on our website. I know that just when you do this for a while, you overlook some of the basics like that. So I want to mention right on our homepage, mplsrealtor.com, you guys have two options. You can either click on this market data option there, or just scroll down just south, oh boy, just below, well, yeah, south of our calendar, just south of our calendar, you'll find the Today in the Market section. I like that. It's not below, but it's south. Technically not wrong. Oops. So some of you will notice, and you know, I know they're still working on it as we speak, and I just wonder if this is up. So let me just do a quick check here. I know they were just still uploading some of our reports, and I hope they're up, but I can't promise that. So let me just take a look here. Let's just do Plymouth. And we are still on September, folks. So just give us a little patience on that. We're working to get October uploaded. Once it is uploaded, you guys will see you have all these options, right? Everything lives right in this fast stats world. So you'll see the local market updates, probably the ones that you guys use the most and love the most. You'll see the weekly report, the monthly, and some of our other reports as well. So, you know, we call this, I like to call this our PDF world. This is our static reporting environment. For the interactive content, you of course have to hop over to InfoSparks. And just in case, you know, I see a few names on today that I don't recognize. So just in case you guys are, you know, newer to this, go around the matrix, right from the matrix page. You know what? I'll show you guys. Right from once you're logged into North Star, you guys will see right away this InfoSparks button. And I think it should keep me logged in. Yep, I promise I'll read all that later. And then you guys will see InfoSparks right here and InfoSparks right here. So this is where all the interactive content kind of lives. And time permitting, I do intend to go into that. But first, before we dive in, I was encouraged to share, you know, how do we use this stuff? Because sometimes when we just dive in, people don't always understand how this might be valuable. How will this benefit them? So how the heck do I use this stuff? And no, you don't need to be like a numbers ninja. You just need to know how to read charts and numbers, which is ninja-ish, but not full ninja. So how is this going to benefit you guys? Well, listing presentations, open houses, showings, prospecting, lead gen, lead capture, personal marketing. I like to always explain this one. It's me versus the market, right? It's you versus the market. So if on average sellers in Richfield are, well, kind of a funny example because sellers in Richfield are getting 102 or 103%. Let's say Edina. Sellers in Edina are getting, call it 97%, and usually within 50, just call it 52 days. Well, my stats in Edina, right, I get sellers 99%, and I get that done in 28 days. So that's how, you guys get to market yourselves, by comparing yourself to the market average. It's basically like saying, right, look at my track record. It's better than, most. It's better than the market. It's better than what others are doing in the city. That's why you should list with me. So don't overlook that. Maybe it's a softer, thing versus, hard marketing, but don't overlook that small stuff. This is a big one, just managing expectations by helping people understand market realities, right? No, not every home is selling after being on the market for 4 hours, but some are, right? So when we hear these stories, these anecdotes, yes, it's true. There are some listings that go off market in 4 or 8 hours. Does that mean that my $500,000 or $1 million home is going to do that? Well, of course not. Does that mean that my downtown condo is going to do that in this environment? Probably not. Although there's some evidence that's changing. So a few things to think about there. Just think through strategic informed decision-making, and this kind of relates to, identifying growth opportunities. How about segments? Single family seems to be outperforming other segments. There's some evidence the suburbs are strong as well, although we're seeing tremendous growth in demand in the cities, and we'll get into that. I haven't talked to you guys since we released our update to our white paper, our Minneapolis market update. So I've got a few visuals from there that I think you guys will enjoy. It's really difficult to forecast in this environment, but if rates, cooperate and there's enough inventory, which of course there's not, I would expect ongoing sales growth and ongoing, I would expect firm pricing, strong pricing, and all the rest, and home selling quickly and everything else that goes along with that. Okay, didn't mean to nerd out on that list as much as I did. So how do we use stats to answer some of these popular questions? i.e., are we in a buyer's or a seller's market? Look at month supply of inventory. You'll get an answer. How do the property types compare? Townhouse, condo versus single family. You can break things down. How are prices, are prices going up or down, right? You got median sales price, average sales price, price per square foot. How long will it take me to sell my home? Days on market. How much of my asking price can I reasonably expect to receive? Percentage of original list price, and so on and so forth. All right, my friends, brace yourselves. Data analysis is coming to a screen near you, hopefully right in front of you. All right, interest rates. We've kind of been talking about this, really since April, since this all began. I like to call it the AC era after COVID versus the BC era before COVID. BCE, before the COVID era. Rates have been one of these strong points, one of these shining data points that really have encouraged buyer demand. I think you had a little bit of a reshuffling, folks who feel they're kind of stuck in a small space when they've got two spouses working from home and a kid or two or three tele-learning, doing the remote learning thing. There was already a little bit of a shuffle, but rates, I think, added this incentive where people want to capture this and they want to say, hey, I want to lock in at 2.7, 2.8%, over 3.5, or God forbid, 4%. Oh my gosh, 4% interest. How will we survive? How will we eat and pay our CenterPoint and Xcel Energy bills? I don't know, but I know that the long-term interest rate is about 8%. So anything better than 8% is quite attractive. All right, so here's our 30-year fixed rate mortgage. You guys can see I wasn't lying, right? 2 3/4, just about 2.72. Well, we can see it was at 2.8 not that long ago, just a few short weeks ago. You can also see that Fred, this is the St. Louis Fed. They have this Fred system that is just fantastic, by the way. You can see they're starting to mark this recession the same way they marked that 08-09 recession with this bar. These shaded areas indicate recessions. I've even got the link up here. I guess why not? Let me just give it a click for you guys. And you will see exactly what I just showed you. There's that 2.72. And there's the Fred system here. What's so cool is you can kind of mouse over and see where things are and where they've been. Some of you will remember the early 80s, where interest rates were 17, 18%. And don't forget, guys, people were lining up to get mortgages back then. Now we're wondering, oh my gosh, if it ever goes back to 3%, that'll just be totally unaffordable. And 4% is just out of the question, right? Sometimes millennials, huh? It's important to kind of remember where things have been and put this in context. It wasn't that long ago we were flirting with 5%, 4.94 in fourth quarter of 2018. So it wasn't all that long ago. When you think about 5% now, I mean, it's almost double where we're at. So pretty interesting changes on the finance side, on the interest rate side. Just like I said, there's our fourth quarter 2018, near 5%. We are now at about 2 3/4. And that is a more than 56%, nearly a 60% decline in interest rates. So, this is a saving grace, you guys. This has offset, the attractive rate environment has offset some of the affordability challenges that are brought on by rising prices. So this can counteract that a little bit, not all the way, but a little bit. Sounds like someone is fondly remembering 19% interest rates. And yeah, going through some interesting parts of life, I suppose. All right, thanks for that. That is interesting. All right, so there you go, guys. Just kind of looking at the rate environment there and how it's impacting the market and how buyers feel, this is an incentive. As economists would say, this is a carrot dangling out there. People want to go out and grab the carrot. People respond to incentives. They feel motivated or incentivized, to make the move now while interest rates are, fantastic. Say they were going to move, next year, maybe you move that up a little bit based on this. So really a historic rate. I don't think we'll ever, well, I shouldn't say never. It is unlikely we will see this in the near and medium term. It's really hard to see this happening. No one thought we'd go under 4%, and then no one thought we'd go under 3%, and here we are, technically closer to 2.5 than we are to 3. Again, a pretty remarkable feat. All right, let's talk the market, guys. 3 overarching trends. We've had these, I think I've had this slide to kind of get our thinking hats on for at least 3 or 4 months here. So buyer activity remains strong. We are hearing it is a frenzy. We're also hearing the word, it's relentless. Buyer activity is relentless. Of course, there just isn't the supply to match that demand. So that's the challenge, which I really skipped to number 3, but let's talk sellers just for a second. Seller activity, I think we saw what? 8.5% bump in new listing activity for October, right? 8.5% bump. But look, we're still down 1% on the year, while demand is up 8.5% on the year. So this is causing some friction, right? The fact that we have fewer new listings and far fewer active listings, right? Down about 1/3. It's pretty remarkable that buyers are able to push this year-to-date sales figure, up 8.5% compared to the same year-to-date period last year. So that's a pretty remarkable feat, once again. So yeah, so seller activity still weak, even though we see some bumps on a monthly basis. We see some spikes on a monthly basis. Like we saw year-to-date and rolling 12 months, it's just insufficient. We don't have the seller activity. We don't have the listing activity that we need given where demand is. Inventory, like I alluded to, it is still by far the biggest factor that's holding back sales and, of course, frustrating buyers. I know you guys feel this. I know you guys see this. I get to sit at my desk, just kind of looking at the stats and the reports and running all these things, but you guys are out there living it and breathing it. And you know what a undersupplied market is, what it feels like better than I do. So here we are. We already kind of snuck into this slide a little bit, but I want to talk, this is important, guys, because, and forgive us again, we're still working with Showing Time to get these reports online. So I do have the PDF, and that's why I'm showing you this right now. So like we saw, 8.5% on new listings, still down on the year, a pretty remarkable 22% gain in signed contracts, about 8.5% on the year. And finally, guys, closings weren't up nearly as much as pendings. What it tells us is that some of these signed contracts, the vast majority of these signed contracts are finally hitting the closing table. lenders were busy. They had a lot of refis. They had a lot of purchase applications. They were busy. So we're finally seeing, all that pending purchase activity transition into closed deals. And that's obviously important. Days on market, market times, we scrubbed off 11 days, 46 down to 35. That was about a quarter better, right? 24% faster. Homes took 24% fewer days to sell. Homes sold 24% faster. Again, 46 down to 35 days. So on average, just about a month, maybe a month and 3 or 4 days, right? I guess depends on the month. For February, it's, I suppose, a month and a week, depending if it's a leap year. On the year so far, yeah, all right, so 48 down to 45, more like 6.5% faster. Sales price, so this is an interesting one, 315,000 up 12.5%. That is a strong gain. And you know what, guys, forgive me for popping around, but I'm gonna do this little trick again. Let me just pause on sales prices here. Let's go into median sales price. So let's take a look at this. I know I'm usually one to say, let's take a look at, the last 3 Octobers, the last 3 year-to-dates, and let's take a look at this long-term trend going all the way back to 04. But guess what? Today and lately, I think it's important to look at the data table. So look at the year-over-year growth. So this is October 2020 versus October 2019. That's where you get your 12.5% gain. But kind of look at the trend earlier, right? So, I suppose even going back last year, I don't know, 5, 8, okay, so an average of what, 7% around the fourth quarter, and then 4, 6, 8, 8, 3, 5, and then look what's happened since summer, right? Really since July. Between June and July, this rate of growth doubled. In fact, you can't make this up, from almost exactly 5.25 to 10.5. So the rate of price growth doubled. And then, it's kind of, the rate hasn't doubled, but it's kind of stayed there, right? It's stayed in these kind of early double digits. So 10, 9.8, call it 10, call this 11. And now, sure enough, we're 12.5%. So price growth, like I said, it's accelerated. It's always been positive, but over these last 4 months, that rate of growth has accelerated. So this is going to cause some friction and some challenges as well, especially once we realize not everybody's income, individual, household, family, not everybody's income is rising at 12.5% per year. So that is, again, gonna provide some challenges for us. All right, let's get back to our fun here. Yeah, PPSF, oops, sorry guys. PPSF about 175 per foot, that's up 8%. So once we actually normalize the data for the size of the homes, so we take that transacted sales price and then we divide out by TFSF, total finished square footage. And once we do that math, we get about 175 per foot. Now that's metro wide, you guys. So I would recommend hopping into Richfield, Crystal, Bloomington, Burnsville, Wayzata, Roseville, wherever you're working. I would recommend going and finding that price per square foot. And then it's pretty easy to just multiply through by that, 1,800 square feet, 2,300 square feet, whatever it is. And that gives you a jumping off point. That is not a magic bullet. That is not a BPO. That is not a CMA, right? That is just one more arrow in your quiver, one more tool in your toolbox that'll help you kind of assess the market and assess how that listing kind of fits into the broader market. I like to point this one out, 100.5%, up 2.5% from 98 to 100.5. You read this right, folks. Sellers on average across the metro are getting, sellers across this metro are getting on average 100.5% of their original list price. So they're getting 100% of their original list price plus 0.5% because of the multiple offers, because of the competitive bidding environment that of course we find ourselves in. Inventory down 35%, month supply down 40% to 1.5 months of supply. Guys, that's 6 weeks of supply, right? 4 weeks is 1 month, another 2 weeks for the half. We're talking 6 weeks of supply. Do you know what we need? We need 6 months of supply, at least 5 months. We donate a limb for 4 months of supply, but here we are, a month and a half of supply, really a tight market. Okay, I'm finding that I am pausing and geeking out on these a little bit too much, so I have to keep moving to get to all my content. So new listings, let's dive into Minneapolis here. So Calhoun Isle, Uptown, Camden, kind of northern, north side, central, downtown, and so on. So new listings, this one's pretty interesting. Up across the board, with the exception of Camden and Phillips, I don't think there's anything to write home about there. In fact, I would go to this rolling 12. And here's where we see the pattern, and this is what I'd expect to see. Seller activity up. Oh, excuse me, guys, I lied. I totally lied. This is what I'd expect to see on the closed sales side, so not on the new listing side. I mean, just understanding that seller activity is up across the board with the exception of Camden. And Camden, you know, if we look at price points, still has some pretty affordable price points. So frankly, if I owned an affordable home in Camden, I probably wouldn't be selling it either. So perhaps that shouldn't be all that surprising. Now let's shift our eyes to closed sales. And this is where we see, this is where we can spot some of the weakness in condos. So there's that Minneapolis Central community, which includes, let's see if I can do it, North Loop, Loring Park, Elliott Park, Downtown East, Downtown West, and Stevens Square, Loring Heights, just south of Loring Tunnel. So in that central community, which again is 90, well, don't quote me, 97, 98% condos, that's where we see sales down 36%. Notice how sales are up, sometimes more than doubling. In fact, there were two areas, Nokomis and Northeast, where sales more than doubled, right, from 56 to 126 and 32 to 66. But we saw this decline in Central. And, you know, this points to some of the weakness that we're seeing downtown, the softening of the condo market. Although, again, like I said, we could be seeing some early signs that that is kind of letting up, and perhaps we'll get back to normal, but, you know, time will tell on that one. And then median sales price. So yeah, a couple down, you know, most up, couple down over the last 12 months. Here again, you guys, this is why the rolling 12 data is so important. The monthly data is great. It's more recent. Obviously, the rolling 12-month data is going to include some BC months, some before COVID months from late last year. So, you know, that's why I don't love it, because it sort of anchors our data way back in the past. But the monthly numbers, while perhaps more current, you know, they only show a small, a small picture. And remember, you're only talking about 9 sales for the monthly versus 126. Well, what if all 9 of these were in, I don't know, let's say legacy condos, or 11 condos are coming online, I don't know when. But let's say they were all in that development. Well, that's not really a good sampling of that neighborhood, and this is obviously going to be better. So let's get back to median sales price, guys. Every area, every community is up, with the one exception. That's where we see our softening, Central, that downtown market. How about days on market? Right, everything selling in less time, with the exception of Calhoun Isle, Uptown. So that's an interesting one. Everything else is down, with that exception of Central, right, where it took 35% more time to get those listings sold, 57 versus 77. So basically tack on 3 weeks onto your market time. So again, pretty good way to get a sense for, what's happening in these different communities. And then of course, I couldn't fit these on the prior one. So I've got percent of original, and then inventory and absorption rates. And let's look at percent here, guys. The sellers are getting, I'd even say, much stronger offers than they were last October. No one was over 100 last October. Now we've got 1, 2, 3, 4, 5, 6, 7, 7 communities are over 100 versus none last year at this time. So that really does point to strength in the market, with the one exception of this Central community, that downtown area, where sellers were accepting 98% of list price last year. Now they're getting 96.5%, which is down about 1.5%. So, again, pretty interesting pattern there. And, I have to say, this does, I don't mean to pat ourselves on the back, I promise, but this is exactly what it's designed to do. This is exactly what we want it to do, to capture these market changes. And sure enough, it sticks out like a sore thumb. Let me also just do absorption rate really quickly. So a couple are up in the city, a couple different areas, but look at downtown, from 3.5 months to 6.5 months. This is technically the only market that is technically just barely a buyer's market, right? 5 to 6 months is balanced. Technically, Uptown is a balanced market, right? You got 5 to 6 months. Technically, that central market, that downtown market, is just barely a buyer's market. All right, let's shift gears a little bit. Let's talk showings. I know we just spent some time on Minneapolis, and I know you guys care a lot about it. We do too. And it's a market that's changing, so it's worth investing some time in. So let's pivot to showings. So this is showing activity current year in blue, 2020 in blue, and then last year, 2019 in gray. Pretty clear here to spot the COVID effect, right? Mid-March, as soon as we had some of the shutdowns and the school closures and that executive order, what was it, Executive Order 2040 or something, you guys can see what happened with showings. As things started to loosen up a bit, and the health concerns have not gone away. They still haven't gone away, but as I think we learned to manage them a little bit better, showing activity really came roaring back. So, around here, we were asking this question: can we make up these losses here with gains here? And the answer to that question is a resounding yes, right? Easily. We've had no problem making up those losses with gains here. You guys already saw year to date sales are already well above last year's levels. So yes, we have made up every single one of these losses. Well, I know we're talking showings, but we've made up these losses in sales. Showing activity translates into sales activity. We've made that up here. So here's something that's interesting. Look at what's happened. So this is pretty recent data, right through this past Sunday. We're seeing a reconvergence, right? So here we saw this divergence where this year really kind of took off and hovered well above, the prior year. Now we're seeing this reconvergence. What does this mean? Well, since May, there was that fateful Memorial Day weekend. Really, since the beginning of June, we saw, this year's showing activity be, hover well above last year. Look at this though, end of October, really beginning of November, we do not see the same kinds of gains. So again, what does that mean? Well, I would expect, even though we showed a 22% gain in pendings for October, I would expect not as much of a gain at all in our November report that'll be released in about a month, just about mid-December. So keep an eye out for that. But I'm not a gambling person. I'm not a bettor, but I would say, I would bet that we would not see similar gains in November that we saw in June, July, August, September, and October. We see November is kind of even with last year. So again, I would not expect huge gains. Overall showing activity, this is good. This is just the numbers. So we can see the numbers declining in these affordable ranges, rising in, some of these middle market move up ranges. I know there's a lot of first time buyers in 3.25 or even 350 and 375. As you get above 450, this seems to be that move up market. And don't discount our luxury market, guys. Luxury has been on a tear, and we're going to see that. I think those jumbo rates are pretty attractive as well. Plus the stock market is kind of back to break even. And I know a lot of those, let's call it what it is. A lot of those high net worth individuals have a lot of assets in equities and stocks. So, that affects their confidence levels. All right, let's weave in a quick joke. Market share, here's the pie. Here's the tin color, the pie that I have eaten. And this is the pie I have not yet eaten. We're going to call that your slice, and then this is going to be my slice. So thanks very much for that. Share of overall showing activity. So I like to look at the percentage. Even if the numbers have increased for some of these segments, the share may have decreased if the numbers didn't increase as much as they did in other segments. I did not explain that as eloquently as I would have liked, but let's just roll with it. So 31% for this week last year, 31% of showings were on homes under 200,000. For the most recent week, right, the week that ended this Sunday of this year, more like 23%. So 31% versus 23% of showings happening on listings under 200,000. We won't go through all of these. Looks like this is a huge jump from 300,000 to 400,000, which makes sense because so many of the homes last year that would have been let's say 280, 290, 409, 299, those have all kind of appreciated into 305 or 310. So it makes sense that we're seeing an increase here because a lot of the listings that would have been here have now sort of aged up into this bracket. I'll say it again, don't discount million plus. I know it's a small segment, but it is a growth segment. All right, let's keep moving. So yeah, change in showing activity. Let's just fix our eyes over here, 800 to a million plus, right? 50% gains in showing activity. Pretty significant change there. It's nice to see this 36% for these 300 to 400,000 listings. That's our bread and butter market. This used to be our bread and butter, but now we have a median of about 315. So this is now our bread and butter. San Francisco's bread and butter is 1.6 million because that's where they are at. So some interesting differences there. And then of course losses in our most affordable segment. So let's do quick month supply. I know we showed some of the September numbers last time. I know many of you know we've been having some issues with our vendor showing time. We've had some technical challenges. Their servers were actually attacked on election day by a foreign entity. I don't know if we can call that, meddling or collusion or exactly what we call that, but they had their servers were attacked, and they're kind of still getting things buttoned back up. So some of these are still stuck on September, but I just want to show month supply. 1.8 months of supply, down from over 10 months of supply. That's September. We just saw October's 1.5 months, so an even tighter market. I also like to think about, I know you guys know this, but again, there's some new folks on the call today, so I just want to kind of cover this. What do we mean when we say seller's market? Less than 5 months supply of inventory, right? So this is a seller's market. You have one seller and you've got 8 buyers competing with one another for a limited supply of homes, right? This is a low supply, high demand environment. The seller's at a relative advantage, faster market times, so on and so forth. Buyer's markets, more than 6 months supply of inventory. Here you've got a lot of sellers competing with a pretty slim pool of buyers. So let's go back. In this environment, these folks have to outbid one another to secure the listing. Here, these sellers have to outconcede one another to lure in the buyers, right? They have to make concessions. They have to do the fixes that come on the inspection report, right? They have to, sometimes lower price, do some seller pays, what have you. So this is your buyer's market. We're shooting for a balanced market where there's roughly 4 units of supply, pretty well matched up with 4 units of demand. Unfortunately, we don't tend to hang out in those balanced markets for long. We tend to overswing center, from 10 months down to 1.5 months. All right, so let's dive in. Let's keep talking about, let's transition into some Minneapolis numbers. Again, I know that a lot of you are passionate about this, and a lot of your business happens in the city, in city proper. So new listings, Minneapolis, this has October data. So you saw that pullback in COVID, and then you saw sort of this relief rally where some of the activity that was missed here kind of came to be here. So, I think overall, maybe we're not that off trend. If you actually smooth out some of these changes, maybe we're not so off trend. So that's seller activity. How about buyer activity in the city? There again, you saw a little bit of this decline in COVID, and then you see this, snapback. What's interesting here is that I think sales have flatlined a little bit, and really, over the last 4 or 5 years. And why are they flat, guys? You all know why. It's inventory. They're running into that inventory wall. It's hard to push sales higher if there isn't the product to write offers on. There you have it. All right, so new listings in the city. So again, we see a little bit of a similar pattern. Here, I think we see, maybe this didn't fall from the sky. Maybe this wasn't so random. I think we do see a little bit of this uptick, in seller activity. So there's September. Oops, sorry guys, this is my mistake. I meant to change this to October. So that's the peak. That's September, but this is October. Actually, yeah. Oops, I screwed up, guys. This 9 needs to be a 10. So this is October right here. The story isn't that different. So I got the trend line right. I think I missed my labels though, so apologies for that. So this is last October, and this is this October. Obviously, this green line connecting the dots is a pretty steep slope, right? It's a pretty steep increase, but that's from October to October. Well, does it make sense to compare a pandemic October to a non-pandemic October? I think a lot of folks would say no. I've never been one to advocate comparing a May to an October. However, 2020 is anything but an ordinary year, isn't it? So, we're bending the rules a little bit, and we're having to kind of squint and turn our heads to the side instead of just looking plainly. We have to look at this stuff differently. So look at May of last year versus, September and, even October of this year. It's not nearly as much of an increase. Why does that matter? Spring market of this year has been delayed into summer. So this summer, and I'd even argue, this fall market sort of resembles maybe late spring, early summer, maybe early summer to mid or late summer. So again, this September kind of behaved like last May. So if you look at that, maybe that's a better apples to apples picture versus looking at, September to September or October to October. So just a few things to think about there. All right, so here's October numbers, and we've got our comparison of a handful of cities, a basket of cities here. And let's take a look. So new listings, Minneapolis, this one kind of stands out to me, right? Minneapolis, so year over year change, 35.5% gain in new listings. St. Paul, only 23%. St. Louis Park, even greater, 40%. Interesting data point there. Bloomington, only about 10%. So 35%, oh my goodness, there's such a huge gain in sellers in Minneapolis. People must be fleeing the city, right? Wrong, you'd be wrong, because the increase in sales is actually 47%. So let me frame that differently. We saw a much larger gain in buyer activity than we saw in seller activity. So for all these listings sellers are putting on the market, the demand is there. The people are there, ready, willing, able, and pre-qualified to write offers. So yeah, earlier on, I want to say earlier on, it was actually listings that were up, 40, 45%. And, sales were only up, I don't know, 5, 10, 20. So things were looking a little bit out of whack, out of balance, a little bit asymmetrical, with seller activity up much more. Now, buyer activity is up much more. So it's hard to make this argument that people are fleeing the city when you see a 50% increase in sales activity. It's also hard to make that argument when we see market times are shrinking, dramatically. Homes sold in 40% less time in the city, right? What is that? Shoot, I wish I think that's 13, 12 or 13 days, which is obviously pretty fast. Yeah, Maple Grove, Plymouth tend to take a little bit longer just because of price point, and there's some new construction there. If you really look at this Maple Grove change, pretty dramatic actually. What are our friends in St. Paul doing? All right, down 41%. So technically they beat Minneapolis just a little bit. How about sales price? Price is up 11% in Minneapolis, right? So 10.8 versus 10.2, 10.2 in St. Paul, but it's about 12.5% metro-wide. So again, I don't think prices would be rising if everyone was trying to get out and no one was trying to get in. Because if that were the case, everyone would be dropping their list price. We'd have all these price reductions. And we do have some, but it's clearly not, how would you call it? It's not unanimous, ubiquitous. It's not prolific. What's the word I'm looking for? It's not across the board. It's not universal. I don't usually struggle with vocabulary, so forgive me. All right, how about percentage of original? 100%, right? Really strong for an October, up 1.5% from last year. Our friends in St. Paul, here again, outperforming us a little bit, 101%. And that's because price points, right, guys? Median sales price, St. Paul. Look at St. Paul, what, about 240 or so versus Minneapolis at 310. So, of course, on more affordable homes, I can write, a little bit of a stronger offer. Let me pause here and just see what's going on in our chat. Breakout Minneapolis, yep, City Lakes area. Why don't you have Lake Minnetonka? Why is that we do. So I'll hop into that in just a moment. So let me try to get to that. Let's keep trucking here. Just one more, a couple more. So new listings in Minneapolis, guys, just kind of putting this in context, right? Seller activity, highest since 07, pending sales. buyer activity, highest since, '04. So Minneapolis new listings are their highest since '07. Minneapolis sales are their highest since '04. I think that would surprise many people, especially if we believe what we're reading on social media. I'll channel Mark Twain and say, if you believe everything you read, you had better not read. There again, percentage of original, 100.5%, and well up from where it was. And it looks like things have been cooling a little bit. And then clearly, as the song goes, there's something happening here, right? So let's talk segmentation a little bit before we transition into some of our other local market updates. So I like that you guys are eager for that. I do appreciate that. So percent of original list price by property type, right? This is metro-wide. Of course, this is from InfoSpark. You guys can pull up any city, any neighborhood, any zip code, any school district, and break things out by property type, just like I'm doing here. So single family in blue, well, let's skip. Single family in blue, townhomes in green, right? And then condos in red. And here we can see that softening, right? This is what it looks like. This is what a softening market looks like. Sellers are getting a lesser share of their list price, right? A smaller percent of that original list price. Here's what's interesting though. Some people are convinced that this is all 100% COVID related, right? It has to be COVID, and you know, there's nothing else. Well, the reality is, folks, this condo market was actually softening starting in August of last year. So this has actually been a trend that's a year in the making. You know, again, here's the beginning of 2020, right? This is a little bit BC, a little bit before COVID. We had already seen some of those declines last year, and they have continued. So these are the facts, whether we like them or not. Science and math is real, whether we believe them or not. The virus is real, whether we believe it is or not. It'll get us sick, whether we believe it or not. All right, what else we got? Let's keep moving here. So this is now the average. So we just looked at the median. How about the average? This is where you see, so not only are more of these listings of single family and townhome listings going at or above 100%, this one shows kind of how, you know, just how much they're getting over or how close they're getting there. So, you know, average is, you know, going to be different based on activity above and below. But here we can see this, you know, kind of hockey stick with single family and townhomes, and really not the same case with condos. All right, pending sales by construction type. So this is where we see our 43% gain in new construction. So this really does feel like a growth market to me, especially as folks are thinking about more space and a bonus room and, you know, finishing off an attic or a lower level from a builder, something like that. And then, you know, existing up 22%. So this is the dominant market. This is the dominant segment. But new construction, even though it's what, you know, 10% of our market or whatever, the growth is twice as much. So it's growing twice as fast. Pending sales by property type. So here again, we see, careful here, guys, this is September. So here we see that 34% increase in signed contracts on single family, 17% increase on signed contracts for townhomes. And there we saw our 2.5% slump, our decline in signed purchase agreements for condos. Now let's look at October. Interesting, already I'm actually seeing an 11.5% gain in signed purchase agreements for condos. So, you know, September, you know, oh God, 2.5% condo, you know, we can all wave goodbye to the condo market, right? Well, hang on, based on the October data, things might be coming back a little bit. So again, interesting data point there. You know, size matters, you guys. When you're talking about the square footage of listings, you know, people care about that. You know, over the last few months, we have seen this 2,500 square and bigger segment. We've seen that as the strongest gainer. And I guess I'm a little bit surprised that we don't see the strongest gains there. We do see the strongest gains in this 2,000 to 2,500 square range, you know, and slighter gains, you know, in the smaller segments. All right, just a little bit of bedroom talk here, if you'll indulge me. So 4-bed homes, all the way down to 1-bed homes in blue. So here we do see, this is what I would expect. So 27% gain in signed contracts on 4-bed homes versus 23% on 3-bed, 22% on 2-bed, 14% on, obviously condos and townhomes and other products down here. So this is in line with my expectations. I know we talked luxury just briefly. Let's just pause on this for 1 second. This is August. I'm going to show you September next. So August, we had a 12.5% jump in million-plus deals. It's up from 70 to about 120. Well, wow, fast forward to September. I mean, the peak of our bubble, we had 60 in 05. We had 130, right? More than twice as much. And up 62% from from September of 2019. So this is a pretty amazing figure. Yeah, that's a pretty remarkable gain. And again, in May or June of this year, if you had told most people that, I'd expect million plus to be, up 60, 70% later this year, I don't think they would have bought it, honestly. All right, this one's interesting. I like to follow, this is Dr. Elliot Eisenberg. He calls his shop Graphs and Laughs. I feel like that describes a lot of my webinars as well. Well, I hope. For the 9 months ending 3/20, 14% of all homes were priced at $500,000 or more. Between April of this year and June, that percentage jumped to 25%, right? Since the start of COVID, the home buyer median income is 110 compared to 94 for pre-pandemic purchasers. So of course, not surprising, that percentage of first-time buyers was just 31% ending 6/20, down from 33% for the prior year. So yeah, I think he nailed it. Affordability problems are mounting. Let's talk new construction for just a bit. And I'm going to skip some of these so I can get into some of the other local areas. So here we are, lumber wars, right? Just when we need them. Something that a lot of folks in the industry were surprised by was the fact that the Trump administration, in this trade war kind of environment, they put a 24% tariff on Canadian pine. Well, a lot of builders use Canadian pine to frame their homes, to build their product. If they're paying more, guess what? They are not charities. Excuse me. They may have a charitable arm, but they're going to pass those costs on to consumers. So that's a challenge. Builders. Who's got the most inventory? No surprise, Lennar. Followed by M&I and then D.R. Horton, and then all the way down you see Robert Thomas, Hanson, David Weekley. See some other ones that you guys will probably recognize. This is from a recent webinar I was in from the Zonda folks, which is the same as Metro Study. And a lot of this stuff isn't public, so I had them send me the slides, and I just want to share a few. So this one looks at starts and closings, by city. Obviously, Lakeville still really leading the pack. But this is interesting. Look at starts are outpacing closings in Lakeville, but closings are outpacing housing starts in Woodbury. So that's kind of interesting. And then it looks like Plymouth and Blaine as well in particular, where you see demand, for that new construction is outpacing that new supply, the start. So the sales outpacing the starts. All right, we'll blow through this. So Hennepin, the biggest, followed by Washington and Dakota. Nothing too exciting here, other than looking at starts and closings and sort of that balance, the balance between the two. All right, so CoreLogic, a different way to think about pricing, especially in comparison to other regions, comparable regions, sister cities, what have you. So there we are, U.S. national average about 5.7. Here we are 5.8. I know we like to think everything is above average here, but here we're only about 0.1% above average. Phoenix and Seattle and San Diego, Tampa, Cleveland, still going pretty bonkers. But we do see some, well, not a decrease, but we see a decelerating rate of price growth in really some of the most expensive metros, San Francisco, New York, Chicago up there as well. Another interesting one, I hope I'm not saying that about all of these charts. Look at this one, guys. Forget this. Look at market rent versus effective rent. Right, so they're having to make some concessions. And look at this, as occupancy rates have gone down, well, why? Everybody's buying homes, right? There's a frenzy to buy homes. So, also some folks, if you experience job or income loss, some folks are doubling up with mom and dad or what have you, or some boomers are, going into caregiving, more permanent care. So effective rent softening a little bit. I thought that was interesting. All right, so seller tenure. How long are people staying in their home? So this is a new data point, 2020, 10 years, you guys. We used to say people moved every 5 to 7 years, and sure enough, right, 6, just in the middle of that 5 to 7. Not roughly, but precisely in the middle. And then after the Great Recession and the mortgage crisis, people were kind of staying in their homes longer. And then as we've had these affordability challenges, listen, if I own a home if I'm paying a mortgage on a home that I purchased for $200,000, or let's say I bought it for $200,000 and I only had to borrow, $180, and now I've paid it down to $140 principal or whatever, I'm not going to let it go, right? I wouldn't sell it, because where am I going to go? I can't find anything at that comparable price with a similar size, in a similar school district that's similarly remodeled, in a similar location. So there's a lot of different factors kind of driving this. Also, as rates got really low, I think people looked at a 4-bed home versus a 3-bed, a 2,500 square foot home over 2,000. So people kind of bought, they squeezed, they pushed themselves a little bit and expected that longer term purchase. Let's skip this. New construction, what's holding things back? I like to cite the 5 L's: lots, labor, lending, lumber, and laws. Let's skip some of this affordability stuff, guys, only because, I hear you when you say you want to dive into some of these areas. All right, so here we are on affordability. Let me hop into some of our local market updates here. All right, so let me go back. Someone is asking about Lake Minnetonka. Okay, was that Orono? So we definitely do have it as an area. I appreciate that question. So let's look at fast stats here, guys. And by the way, I have to do this. I like to do this just as a reminder. I can either get to it here or I can get to it here. So I'll click these local market updates. That'll take us hopefully to fast stats. I'll click Hennepin County and I'll click this Lake Minnetonka area. So there you have it. We have every city in that, greater Lake Minnetonka area, the greater Lake Minnetonka basin. So everyone can go cleanse themselves in the waters of Lake Minnetonka, although I bet they're a tad frigid this time of year. We could go and ask Willy Wonka from Lake Minnetonka, but I think he's busy. So Orono, we'll just click Orono. There you have it, 871,000. Seller activity up about 10, buyer activity up about 5. People spending $250 per foot. Sellers are getting not even 95% because of this price point, right? So let's get out of that. And also, days on market, days on market, a little bit longer, even though it's down by half, we're talking 65 versus 35. And 4 months of supply here. So still technically undersupplied, if you can believe that. But, much better than the 1.5 months of supply that we have across the metro. Let me just do Wayzata. I know that's another popular area and another pretty high-flying market. And boy, oh boy, high-flying market is right. Median in Wayzata, 1.4, we might as well call it 1.5 million. I know, is it the Landing? I know there was some real luxury product that just opened there. So I would bet that's driving that. I mean, this is a pretty remarkable increase, even for 15 sales. But look at this, sellers are only getting, because this price point's so high, sellers are only getting 93%, not even 93% for September. So 4.5 months supply, pretty close to the 5 months of supply that would be balanced. And look at here, over 3 months, 3 months and a week, 97 days on market. So quite a while, right? Sellers have to be patient, especially at this price point or even that price point, right? Or really anything above 450 or 500, you're going to see market time start to increase. All right, let's see. It'll be interesting to break out Minneapolis. Yeah, we definitely can do that as well. I mean, we already kind of did. But just so you guys know, we can take a look at this whole Minneapolis report. So I'll give this a click. So now we've got citywide figures, right? There's our 305-ish. There's our 47%, 23%. Even though, remember, these are switched for October. In fact, let's see. Those are perfectly switched for October. Let me hop in. Sorry, I'm showing you guys a little bit of the sausage making back here. All right, there's Minneapolis. Just like I told you guys, I promised, closed sales 45, new listings 32. So there you have it. Even though over the last 12 months, yeah, listings up 11.5% versus just 0.5% for sales. But there's our 310, 312, 220 a foot, 100.2%, and pretty quick market and a pretty tight market. And then, yes, so one of the things I showed you guys early on in the slides came right from here. It's just page 2 of that local market update. That's where we see all these breakouts. So again, our uptown, north side, Longfellow, lower north side, South Minneapolis, Nokomis, Northeast, as they call it, and so on. So yeah, that's all here for you guys. Please do use it, love it, share it, post it on your Facebook, your Twitter, whatever you guys do it. And yeah, this stuff is really here for you guys to use. Let's do a time check. Oh boy, I've only got 4 or 5 minutes. I could go on for hours, but you guys won't indulge me with that kind of time. So, just to kind of wrap up, let's just do a few of these. Oh, you know what, guys? I did want to do just a few on the economy. So just bear with me a little bit. I want to do a few on the economy here because we really haven't touched on that in several months. So our jobs recovery, right? We still need another 10 million just to get us back to break even, back to that prior peak. So, people look at this and they say, oh my God, we added millions of jobs. That's true. We added 4 million, but we lost 30 million. So we're net down, 20 or, whatever it was. Even though this looked like a strong gain, in the scheme of things, we're still well below where we were. GDP, gross domestic product, in seasonally adjusted annualized rate. You guys can see the COVID effect. We've come back, but we're not yet back to here, much less, we have to make up because this trend likely would have continued, for some time. By the way, look at this GDP trend going all the way back to 2012. This is pretty linear, you guys. I don't really see a ton of change. So, some people have different ideas about what's happening with GDP. Check out this one: home equity cashed out by cash out refis in billions. Look at how we treated our homes like ATMs in 05, 6, and 7. Look at how many billions we cashed out. Now, take a look at this. Even though prices are above 06 levels, we're not treating them as ATMs, right? So were we to have a housing crisis, by the way, this COVID crisis really, I suppose that's arguable, but the housing market has really performed well this year. It's outperformed expectations. So COVID did not have, the harmful impact on housing that some feared it might. And, typically, that you might expect during a recession, even though this is a brief recession. So this is pretty telling. Were something to happen to home prices, look at how much more cushion buyers have. So they won't have to sell short. They won't have to go into foreclosure, so on and so forth. All right, we're getting real close to time. So, just of the roughly 6 million families given forbearance, a little under half had the forbearance extended. And then this is interesting. So about 45%, the forbearance was removed while that loan was performing or the mortgage was paid off. And then, yeah, a pretty small share that are in expired or delinquent, status in the mitigation phase. I think of this as like the redemption period versus, officially expired and formally delinquent. So kind of interesting there. All right, I love this one. It's not good news, but I love how explanatory, I like how this can illuminate some things going on. So this is the K-shaped recovery, you guys. I know we talked about U's, V's, W's, L's, other alphabet soup. K-shaped recovery. The economy came down, and then guess what? The business professionals went kind of back up. Some are even ahead of where they were, before everything changed. And then everyone else is kind of, retail, restaurant, leisure, bar, hotel, other service-oriented industries. Oh my gosh, airline, cruise, theater, right? So everyone else is experiencing this. A lot of the business professionals are experiencing that. That's why they call it a K-shaped recovery. I just find that so fascinating. It's a little bit depressing, to be honest, but it's a fascinating tool, to think about this. So yeah, just like we talked about, recovering tech, some retail, software, and then needing some help still, travel, entertainment, hospitality, and food. So maybe I'll leave you guys with this one. So let's take a look at how home prices performed during the last 6 recessions. Well, they rose during every single recession, minus that Great Recession, 2008, where home prices did take a hit. And remember, that recession was caused by housing, right? It was a lending crisis. It was, it was a mortgage crisis, a foreclosure crisis, kind of unregulated lending. If you can fog a mirror, you can get a mortgage, that sort of thing. What's interesting is, housing led us into this recession, housing led us into this 2008 recession. Now, though, it looks like housing could lead us out of recession, or at least help us out of recession. So again, I find that just so fascinating, as I do many data points. Let's see, guys. All right, you know what? I'll do one more, even though it's not necessarily a happy one. In this moment of sort of awakening around issues of racial justice and equity and DEI, diversity, equity, and inclusion, I think it's important to talk about our housing gaps, our home ownership gaps. I bet most of you, thought this, but I bet most of you didn't know the actual number. So here's what I found from the census data. Within the white community, within the metro, right, almost 76% home ownership rates. Within the Asian community, right, little under 60% in the metro. In our Hispanic Latinx community, about 49%. In our American Indian and Native community, 42%. And then in our Black African American community, actually about 25, 26%. So it's 1/3 the ownership rate, right? 25 versus 75. That's pretty dramatic. And that didn't just fall from the sky, right? It's rooted in a lot of things, but it's rooted in, right, the education gap, the wage gap, right, the generational wealth transfer, the wealth gap, the income gap, right? It's rooted in so many different things. I find this one so fascinating. Everyone is a little bit higher outstate than in the metro. The Native community is much higher outstate because of some of the sovereign nations and, home ownership on these tribal lands. And I found this one interesting as well. Within the Black community, actually higher rates of ownership in the metro than outstate, even though every other community has higher ownership outstate, I should say in greater Minnesota than in the metro. So some pretty interesting observations there. And with that, thank you guys for indulging me an extra 3 minutes. I really do appreciate it. And you can throw any questions in chat. I'm happy to stick around for an extra 10 minutes if wanted, if needed. Otherwise, I suppose I should formally say, I want to say thanks to Bell Bank and North Star and Royal Credit Union, as well as Supra, our sponsors that help us make this possible. I should also mention a recording of this will be available on our website. So if you want to take a look at it, please do check it out. Feel free to email me if you want these slides. I'm more than happy to share, or someone from our education team will get these out to you guys. I also want to say, please do check out our recent webinar, TOPA Talks, with my counterpart colleague, Eric Myers. There's some interesting policy proposals in Minneapolis that will have impacts on your business, and it's worth kind of getting in touch with that and learning what it's about. So do visit our TOPA Talk, and you'll see the link on our website.
All right, thank you, David.
You bet.
See, I'm not seeing any questions coming in. There was a comment regarding your last slide that you shared that 25 to 76% is the highest of any major metro area in the US.
I do believe Jim is correct. Yes, I do. In fact, watch this. I'm so glad you mentioned that. So this is the only one I could find, and it drives me crazy that I can't find a 2019, but a couple years old. This doesn't change that much. So to Jim's point, all right, so a couple years ago, here we had about 73% home ownership. I thought there was one or two that beat us. Michigan just barely South Carolina, this one kind of surprises me. And then West Virginia. And I think what's happening in West Virginia, you can buy a house for 60 grand. And, I know there's a lot of coal mining jobs and, maybe they don't pay as well as software development, but, homes are pretty affordable in that state. And, maybe incomes aren't so bad. So, that allows them to have a higher ownership rate. And then in these far northern New England states, pretty high as well. But yeah, we've always been in the top, 2 or 3, I suppose, maybe 4 for years. So it's absolutely an accurate comment. California, interesting, right? I would suspect within the next 10 years, they will be below 50%, where they will be a majority renter state. So that one's pretty interesting as well. New York is even closer, right? New York's almost there. Well, I should say DC, even though it's not a state, right? The district, only 40% home ownership rate. And the rest are, legislative aides, none of whom can afford to buy a home in DC. But New York also just about half and half renters, half homeowners.
We had a question just come in. Can you speak to showing activity regarding early snow or election?
Ooh, good question, Julie. Showing activity. Yeah, I mean, I guess I would say that the early snow, I think we can see that here, right? So what was it? Kind of that late October. Some of you will remember the the Halloween blizzard, only 21 years ago. So yeah, I think I think as we saw that early snow and that cold snap, right? I think that maybe this would have been up here without it. And I think, obviously since it's down here, I think that could have an impact. I also think inventory, it's hard to schedule showings on, evaporating product. There's just so little under 300,000, under 250 in particular. So, no surprise. And again, we made up all these losses and then some with gains here. So it's not alarming that we've sort of reconverged here with the year ago trend. But I do think it'll mean that we shouldn't be expecting huge sales gains moving forward. Still a strong market, but I don't know about these huge gains. And then Shay has a good one. Let's see. Do you have any data for homeownership rate as a whole in Minneapolis? Considering, all these renter-centric proposals. Yeah, I know Shay has been really involved over the years with our government affairs efforts. So thank you to Shay. I know Eric is really appreciative as well. I do not have anything ready, for the Minneapolis, for the city proper as a whole. You know what? Hang on, we might be in luck. Gosh, could I be this prepared? I'd be surprised. Let's see, I always have a few after my Q&A section, you guys. I always have a few. Love. You got to have that one these days, huh? Okay, here we go. So this one's old. Gosh, I'm so glad Shay asked that. This one's old. This one is from 2015. So this one's 5 years old. But here I actually broke out Hennepin, Ramsey, Minneapolis, St. Paul, and then the whole Twin Cities metropolitan area. So we've got our white community and then BIPOC, Black, Indigenous, people of color. And you guys can see the difference. So Minneapolis looks like a 60% homeownership rate amongst the white community versus about 23.5% for the BIPOC community. So Twin Cities overall, okay, about 76, 77%. Minneapolis, right, that's 62. Well, that's for the white group only. Overall, 71 versus 50. Sorry, guys, that's St. Paul. 71 metro versus 49 in Minneapolis. And then, you can kind of see Ramsey versus Hennepin counties as well. So I think this is just fascinating data. And, when you look at St. Paul, some of the affordability, some of the more affordable product has allowed communities of color, better access, folks that have been, who have frankly faced a legacy of housing discrimination, right? That goes back how many decades and in how many different shapes and forms. So, having some of that affordable product is obviously helpful across the board. But yeah, I think Shay really brought up a good question. What we did find actually, now that I also think about it, Council Member Lisa Goodman asked us, and I pulled some numbers and I actually showed, I believe Minneapolis is now 53% renter. So it is majority renter, technically, not by much. I don't think that means that the council should do things that harm the 47% of people that do own their home. And remember, the 53% that rent, someone's got to own that property, right? And if they can't set rent, if they can't, have flexibility and have, the liberty of doing, what they want with their property within the law, that will harm the availability of rental product. And, will people be as likely to buy that product and rent it out with some of these new constraints? I think the intent is good, right? Renters need help. So do homeowners. Everybody's looking for some help. In policy, I'm not necessarily talking handouts, but policy, incentives, tax credits, whatever it is. So, I appreciate the intent of addressing, the renter affordability crisis, but so many of these policies will have the unintended consequences, and sometimes they can have the exact opposite effect of what was intended. So I think it's really important to look at that. And, Eric and I and Shay and others and Jerry Moskowitz and a whole lot of other, volunteer members, our leadership really, has engaged with city council and planners and council members to get that point across that, we understand there's concerns, here's some alternatives that we'd like, and here's why what you're considering may not work, may not have the intended effect. So great question. And I didn't mean to wonk out on that for that long.
All right, I'm not seeing any other questions come in, so.
We're feeling pretty good.
Yeah, I think we can probably call it a day. And just a reminder, the recording will be on our website, and we will send out an email with it and the slides as well. So.
Thank you, everybody, and thank you, Anne.
Thanks, David.
Talk to y'all later.
Bye.